Ladies and gentlemen, good day and welcome to the Yatharth Hospital and Trauma Care Service Limited Q2 FY2026 earnings call hosted by Elara Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kashish Thakur from Elara Capital. Thank you, and over to you, sir.
Thank you, Yusuf. Good afternoon, everyone. On behalf of Elara Capital, I would welcome you all to Q2 FY26 earnings conference call of Yatharth Hospital and Trauma Care Service Limited. From the management, we have Mr. Yatharth Tyagi, Whole-Time Director, Mr. Amit Kumar Singh, Group CEO, Mr. Nitin Gupta, President Finance and Chief Operating Officer, Mr. Pankaj Prabhakar, Group CFO, and Mr. Ashutosh Kumar Jha, Group Finance Strategy, Merger and Acquisition, IR, and Mr. Sonu Goyal, Group Finance Controller. I now hand over the call to Mr. Tyagi for his opening remarks, and then we will open the floor for question and answer. Over to you, Mr. Tyagi. Thank you.
Good afternoon and welcome to Yatharth Hospitals and Trauma Care Services Limited's earnings conference call for the quarter ended September 30, 2025. Joining me today are Mr. Amit Kumar Singh, Group CEO, Mr. Pankaj Prabhakar, Group CFO, Mr. Nitin Gupta, Group COO and President Finance, Mr. Ashutosh Kumar Jha, Group Chief Strategy, M&A and Investor Relations, and Mr. Sonu Goyal, Group Finance Controller. Our earnings presentation is available on the stock exchange and on our website. We hope you have had the opportunity to review it. This quarter marks a significant phase of operational and strategic progress for Yatharth Hospitals, delivering industry-leading performance with the highest ever revenue and EBITDA. A key positive milestone this quarter has been the order from income tax authorities unfreezing the provisional attached properties and fixed assets of the company, restoring full financial flexibility for expansion initiatives. This milestone marks an important step towards the resolution of a long-pending income tax issue. Upholding highest standard of governance, we are happy to announce the appointment of Mr. Ramesh Krishnan as Independent Director. He is a healthcare veteran with 3 decades of experience leading hospitals and private equity in the healthcare space. In our latest annual general meeting, we have also appointed MSKA and Associates, a member firm of BDO International, as our statutory auditor with effective from Q2 itself, further reinforcing highest standard of transparency and governance for all our stakeholders. We are also pleased to share that CRISIL has upgraded our credit rating to CRISIL A Stable, reflecting the strength of our business prospects. During the quarter, we operationalized Model Town Hospital in New Delhi during mid-July, adding 300 beds to the capacity. Moreover, we also commenced operations at a Faridabad Sector 20 hospital, adding 400 beds to the capacity. We are already seeing increasing footfalls at both these new hospitals. With our advanced infrastructure and clinical team, we expect both these facilities to be a key growth driver in the upcoming quarters. Continuing our expansion strategy, we also this quarter acquired Shanti Ved Hospital in Agra, having an expandable capacity of 250 beds. This hospital is already running and hence will contribute meaningfully to both our revenue and profitability from day one of its integration. We expect this integration to be completed by H2 of this fiscal itself, and we should be adding revenues and EBITDA of this hospital from Q4 of this financial year. Our commitment to clinical excellence is also demonstrated by several technological adoptions and complex procedures conducted this quarter. We utilize the latest navigation system and IntelliJoint software to perform Delhi's first ever robotic intellectual hip revision surgery at a newly started Model Town hospital. We also adopted Rapid AI, an advanced AI-enabled neuroimaging technology for fast and accurate stroke detection at a Greater Noida facility, enhances diagnosis and treatment timelines. These advanced procedures position us among a select group of hospitals in North India providing these cutting-edge clinical care. We've also made significant strides on the medical value travel front. In Q2 FY26, we established Yatharth representative offices in Baghdad and Tashkent in partnership with Chinor Medical Center and expanding into Cameroon through both institutional and private partnerships. We are also in the process of being the exclusive healthcare partner for the upcoming Jewar Airport, which is expected to drive international patient volumes from these regions, and presence of Yatharth Hospital clinical medical examination room at the Jewar Airport will also enhance our visibility to the passengers, both domestic and international, using the airport. I would also like to take this opportunity to highlight a key industry-wide development this quarter. With a long-awaited central government health scheme, CGHS rate revision after more than a decade, effective October 13, 2025. We welcome this move, and the new framework introduces rationalized tier-based rates with higher reimbursement for accredited super specialty providers in metros. The structural change will significantly enhance our revenue realization and profitability across all our hospitals. Looking ahead, our focus remains on ramping up the new facilities, expanding super specialty offerings, and driving operational efficiencies across the network. We are confident that these initiatives, combined with a robust governance practices, a strong management team, will help us deliver sustained value to all our stakeholders. With that, I would now like to hand over the call to Mr. Pankaj Prabhakar for a detailed financial update.
Good afternoon, everyone. I am pleased to say that Yatharth Hospital has delivered another quarter of records revenue and EBITDA. During quarter 2 FY26, we recorded revenue of rupees 2,794 million, reflecting a healthy 28% year-over-year and 8% quarter-over-quarter growth. Our newer hospital were key growth drivers, reporting a significant 110% YOY increase, while our mature hospitals sustained the upward trajectory, reporting a 19% year-over-year increase. Notably, Greater Faridabad, in its first full year of operation, now contributes 10% of our overall growth revenue, reflecting the strength of our expansion strategy. During the quarter, we have added 700 beds with commencement of our New Delhi and Faridabad hospital. However, despite the bed addition, our occupancy stood healthy at 66% during the quarter. As far hospital-wide occupancy is concerned, our Noida Extension facility achieved an occupancy of 89%, Greater Noida at 69%, Noida Extension at 64%, and Jhansi Orchha at 71% during the quarter. Our strategic focus on high-value super specialty care and continued investment in cutting-edge medical infrastructure has resulted in an increase in consolidated ARPOB to rupees 32,015 in quarter 2, FY26. Notably, mature hospital, which includes Noida, Greater Noida, and Noida Extension, achieved an ARPOB growth of 9% year-over-year, while our newer hospital registered an ARPOB growth of 19% year-over-year, reflecting our continuing focus on improving the mix. Our Noida Extension Hospital achieved its highest ever ARPOB of rupees 40,800, up by 7% year-over-year, given its approximately 70% contribution from super specialty services. Our Noida Hospital reported ARPOB of approx 31,100, Greater Noida at 38,300, and Greater Faridabad at 31,900. Our Model Town New Delhi facility began operation in the quarter with an initial ARPOB of rupees 33,600. As we ramp up our Model Town and Faridabad Sector 20 hospitals, we expect these hospitals to generate ARPOB much higher than our group ARPOB. On the profitability front, EBITDA stood at record level of rupees 645 million, up by 18% year-over-year. Given the initial operational losses at our newly operationalized Delhi and Faridabad Sector 20 hospital, our adjusted EBITDA was rupees 737 million, up by 35% year-over-year, while our adjusted EBITDA margin stood at healthy 26.7%. Accordingly, our adjusted profit after tax grew by 63% year-over-year. Our balance sheet position continues to remain robust with a strong net cash position of rupees 3,692 million, providing ample financial headroom to capitalize on suitable growth opportunities. Looking ahead, we remain optimistic about sustaining our growth trajectory. Our strategic priorities will focus on expanding our footprint across North India, optimizing existing clinical infrastructure, enhancing clinical excellence to drive higher ARPOB, and capitalizing on emerging opportunities in the sector. Thank you for your attention. I would now like to hand over the call to the moderator for question and answer session. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Ritika Khandelwal from Perpetuity Ventures. Please go ahead.
Hi, thank you for the opportunity. I just wanted a bit of clarity on Faridabad and Delhi hospitals, the amount of losses that you would be looking at, and since Faridabad has been operationalized right now, and the minority share has been positive, PAT minority share. So are the Faridabad losses being booked? And what are the expectations going forward from the two facilities?
So if you see in Q2, we have around 3.3% is the overall dilution in EBITDA because of the two new facilities, that is Faridabad Sector 20 Hospital and the New Delhi Model Town Hospital. And we are pretty much sure within the next 15 months to 17 months, both hospitals will be EBITDA breakeven.
Also, even though the Faridabad 20 facility was operationalized fully, that is the IPD started on 1st of November, but prior to that for a month or so, almost a couple of months, the staffing was already there. So that's why a bit of the loss is already there, including some of the doctors, nurses and admin staff was all stationed and getting ready for the hospital. So yes, certain of the expenses have been booked for the FY20 and, will also fully be operationalized and fully expenses will be booked from Q3 itself.
What kind of, if you can quantify, what kind of losses are you looking at?
So the sort of the similar of what, the EBITDA loss for the Q2 was, would be a bit similar also in Q3 because of these two hospitals, because Delhi hospital will be then, probably 4-5 months into the operations. So the EBITDA drag there will reduce in Q3, but EBITDA drag of FY20 will increase a bit. So I think similar trend of the EBITDA loss of Q2 should be seen in Q3 from these two specific hospitals.
Also, like for Delhi, what is the run rate currently and what kind of occupancy are you seeing?
So it's a very, it's a very early to tell you that occupancy, because it's just 2-3 months of the operations. But I think 13-14% of already Delhi is operating as of now. Faridabad, we just started it. But as said earlier, we are expecting both these hospitals to have a break-even reaching in a 15-16 months kind of. So I think we are very much up to it, right? Yes, more empanelments and then insurances are, yet to come. So once it will be done in next 4-5 months, I think we would be. As we had said earlier as well, around anything between 30-35% of occupancy, we reach an EBITDA break-even. So that's what we are expecting in next 15-16 months.
Okay.
Sorry to interrupt, Ms. Ritika, your voice is breaking.
For the Agra facility, when is it going to start?
Agra facility, will be on our books from Q4 fully. So, somewhere from the first week of the new year, we should be, starting the facility. It's already a running facility, but it will be integrated on our balance sheet from the first day of Q4.
Okay, thank you. And lastly, just can you tell us the payer mix and what is the percentage of professional fees you are paying to the doctors?
Payer mix is somewhere around, 37% roughly is the government business, and the rest is equally divided between private insurance, TPA, as well as self, that is the cash payer. As far as your second question of
overall, we are at 21.5% in the doctor share, doctor cost percentage of revenue.
Okay.
Sorry to interrupt, Ms. Ritika. May we please request you to rejoin the queue, ma'am? Several participants are waiting for their turn.
Sure.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the question queue, please restrict your questions to 2 per participant. Should you have a follow-up questions, please rejoin the queue. Next question is from the line of Nirali Shah from Ashika Stock Service. Please go ahead.
Hi, thank you for the opportunity. I had a question on ARPOBs. So your slide shows that group ARPOB is moving from 32,395 in 1Q to 32,015 in 2Q. So despite the mature and new hospitals reporting ARPOB growth, this is what we are seeing the difference. Can you reconcile the math, like which hospital or the payer segment pulled the consolidated ARPOB around QOQ and why did that happen?
So, the reason for that is the very strong increase in the occupancy of our Jhansi hospital. We are quite happy that Jhansi Osha Hospital has reached an occupancy of 70%, as per our target, and it's now become a leading service provider in that area. So because the ARPOB in Jhansi Hospital is, almost half of that of the group average, so increase in the occupancy in Jhansi Hospital led to the decrease, not decrease, but muted ARPOB growth. However, with the Delhi and the Faridabad 20 hospital ramping up in the coming quarters, which will have the ARPOB much higher than the group average, we will still be on the track for our, EBITDA yearly ARPOB growth of for the whole year somewhere around 8 to 9% from last year.
Okay, got it. Also on the income tax matter, you've reported that assets have been unfreezed and the FDs have been unfreezed. Are there any residual contingencies or appeal windows or any potential future claims, like any clarity on this matter?
Yeah. So I think this was a major development as far as the whole matter is concerned. We expect the whole matter also to be resolved somewhere, before I think before the end of the financial year. Probably before the end of the calendar year, it will also significantly move towards closure. But I think the right timeline should be before the end of this calendar year.
And my last one is on the capex plan. So we had announced in the previous Concall that somewhere around 1,400 to 1,500 crores for 3 years. Just wanted to know how much additional debt do you plan to take in the next 12 months to fund the brownfield, and what will be the highest cost of borrowing you could consider as an acceptable level?
Yeah. So just a correction here, the 1,500 to 1,400 crore capex for the 3 years means that, we will end up spending it technically in next 5 years, somewhere around 4.5 to 5 years, because yes, deals would be announced for that capex within next 3 years. But, let's say after 3 years is a greenfield expansion that we're doing. The complete utilization of that fund would take somewhere around 4.5 to 5 years. So technically we will be spending 1,500 crores over the next 4.5 years. That's first correction. Second is, as far as the next 12 months are concerned, obviously Agra's 250 beds will be with us in Q4. And then we also remain committed post that. That means, somewhere around H1 of the upcoming next financial year 27. We should also be looking to add somewhere around, 300 to 400 beds through an acquisition or an upcoming project that we are working on.
Got it. I have one more question, if I may.
Mr. Nirali, may we please request you to rejoin the queue, ma'am?
Sure, I will join back with you.
Thank you. Next question is from the line of Param Vora from Trinetra Asset Managers. Please go ahead.
Hello. Thank you for giving me this opportunity, and congratulations for a great set of numbers. So, sir, your Q2 revenue growth is strong. So can you break down the quarter's revenue growth? Like, what did it led to the growth? Like, was it the patient footfall that has increased, or is it the, mix and shift, like specialties, like towards high margin specialty, or maybe the pricing?
Yeah, so it is a mixed. Definitely as you had said that we have still in existing hospitals we have a drivers, be it change of mix or bit of fine tuning the upper existing mix. Second is very good growth as mentioned in the commentary, that 10% contribution is from the new hospital Faridabad 88, right? So all these things we believe that adding a Delhi and new Faridabad sector 20 will add up much more growth. However, there is still good room for our existing hospital, be it a Greater Noida and Noida extension, for upward growth.
Okay, thank you.
Thank you. Next question is from the line of Akhilesh Rawat from Riddhanta Vision Private Limited. Please go ahead.
Hi, am I audible?
Yes, please proceed.
So first of all, I want to congratulate you on the good sets of numbers, and I have basically question regarding this international medical value tourism. So what's your plan regarding this for upcoming financial 26 and financial 27?
So we have a strong team now, and then we have already rolled out our strategy. As recently, we had opened 2 information center and OPD center. One is at Tashkent and another is in Iraq. A few more going to come in African market. So I think that we have identified the pockets, and in this financial year, I think that the strategy is very, very clear that we open around 5 to 6 information centers, and we are working on the channel partners, be it in that particular respective country or the local. So we believe that this financial year or probably the H1 of the next financial year, we will have a very good percentage contribution from the international business, as airport is also going to start by probably the end of this financial year.
Okay. And what kind of ARPOB lift you are seeing from this? Could you quantify on that?
See, I think there is always upward of around anything between 45 to 55%. That's up from your domestic. So you can extrapolate from there.
And my last question is regarding the Agra hospital. Like, when will we see the results in our books regarding that hospital?
As earlier mentioned, from Q4 of this financial year.
Okay. And what kind of ARPOB are we expecting from that hospital, ARPOB?
I think upwards of 30,000, somewhere around that, to begin off with, and slowly as we ramp up more super specialties, that this will has the potential to be somewhere the group average ARPOB and also a bit higher also in the future if possible.
Okay. That's it from my side. Thank you. All the very best for upcoming quarters.
Thank you. Next question is from the line of Akshat Mehta from Seven Rivers Holding. Please proceed.
Hello. Thank you for the opportunity, sir, and congrats on a great set of results. I have a few questions here. One is that, in the Delhi hospital that you just started, we had earlier guided for a 39,000-40,000 kind of an ARPOB number, but in this quarter you've seen a 34,000 roughly ARPOB. Can you help us explain what is the difference here?
See, by Delhi, I would say, it's too early to judge Delhi. Still, there is no insurance, even a cash presence. Initially, there is a very early rates which we have put in market. But in next 2-3 months, if you see when our tariffs and everything is frozen as per the competitive, the insurance negotiation happened, and more and more international flowing in that particular hospital, you see this ARPOB will be much more than what you are seeing as of now. So what we have said earlier, it is absolutely realistic.
Whenever a hospital starts, usually first a few months, it takes for ARPOB building. In fact, we are quite happy that the first month itself it has started with 33,000 ARPOB. That gives us confidence that within 12 months or even earlier, this ARPOB can cross 40,000 rupees, and that's the trend across other hospitals also that we witnessed when we started them.
Okay, sir. Next question is that I want to understand with the losses that we've seen from the new hospitals and that will continue in Q3 and probably in Q4 because Shantived will also be adding, what kind of margins can we look at on a full year basis? And, with the new hospitals being added, I think we can overshoot a number of 30% revenue growth also. So if you can provide a guidance on that as well.
So, Agra will not be a EBITDA drag because when it comes to Q4, it is already an EBITDA positive hospital and even profitable. So there will be no drag due to Agra. That's one. Second, as far as the margins are concerned, I think what we closed the H1 margin for, I think somewhere around that would be a realistic number for the whole of the end year also, maybe 0.5% up and down here. But I think that these margins that we have already will not be dragged further. We are quite confident even for the Q2 margins which are here. It will be only upside from here for the whole financial year. And Agra will be a bit of positive from day one. Lastly, your question on the 30% revenue growth. Yes, I think that's easily visible. I think we being actually a bit conservative when we think 30% revenue growth. We feel that this number should be easily overachieved.
My next question is on the overall capex side as well. So this year, sir, what is the kind of this and next year? What is the kind of capex that we're seeing? That will spend.
So I think we have already given the guidance for next 4.5 years of 1,500 crores of capex. I think we'll just stick to that. We have a good cash position. We are debt-free, and we are generating good internal accruals. So whatever capex is required, the company will be able to very well fund it also.
Thanks. Sir, one bookkeeping question.
Sorry to interrupt, Mr. Akshat. May we please request you to rejoin the queue, sir?
Sure.
Thank you. Next question is from the line of Surya Narayan Nayak from Sunidhi Securities and Finance Limited. Please proceed.
Yeah. Am I audible, sir?
Yes, please go ahead.
Yeah. Thank you for giving the opportunity and congratulations on the good set of numbers. So just want the understanding about the Agra hospital. When we took over, I believe, it is operating at around 40% occupancy, and we have, planned to expand it to 250. So over what period of time the hospitals will be ramped up? I understand that it will be acting as a feeder hospital. Then what would be when we will be able to incorporate all kind of super specialties in it, and when we will be able to get a kind of ARPOB at least of 35,000 plus. That is first.
So, so Agra, we are not just seeing it as a feeder hospital. Agra is a big standalone 250-bedded super specialty hospital. Agra as a market is very fertile. It is we are the first corporate hospital in that region, and it has huge population of not just Agra, but nearby places like Hathras, Safai, Etawah, Shikohabad, and all these patients drain to Agra, and the combined at this level of facility is not there in that whole region. So Agra will be a full standalone super specialty hospital where we will be providing all the super specialties. And even, it will be on our books from January itself of the next calendar year. We will start with 150 beds, but we do not need to do any more capex to reach that 250 bed expansion. Only just beds need to be added. The whole infra is almost ready there for 250 beds. So as and when required, as per occupancy, we will see, and we will just keep on opening floors and putting in beds there. And as far as the ARPOB full mature is concerned, so remind you that because it's already a running hospital, it will not take time for us to develop super specialties much time, because already there's a cath lab, there are cardiac surgeries happening there are angioplasties happening there. A lot of super specialties are already existing in that hospital, so we will see a very good and a very quick ramp up of both the ARPOB super specialties as well as occupancy for the Agra hospital is concerned.
Okay. And just in the previous participants' answers, I just missed the year-ending EBITDA margin considering the 2 quarters hit on the new hospitals' cost absorption. So what would be the guided EBITDA margin for FY26, and whether that will be fully absorbed and will not be incurring more loss in the FY27?
No, so as we earlier said, the EBITDA margin what we have for this quarter, there's only upside from here that will happen for the coming quarter and the whole financial year also, and it will be fully absorbed because yes, there would be next year also we will be adding capacity, but this year if you look at it technically, we have added, including Agra, we will be adding the whole financial year, we would be adding 1,000 beds. So that's 3 new hospitals that have come up. And even with the 3 new hospitals in a financial year, we're able to, maintain margins upwards of 23% of EBITDA. So, whatever in the future is going to be upside from here only.
So, sir, regarding...
Sorry to interrupt, Mr. Surya. May we please request you to rejoin the queue, sir?
Just one follow-up question, sir.
Sir,
sure,
there are many parts.
Okay. Can I, sir?
Yes, please go ahead, sir.
Okay, thanks. So just with long-term ambition of 1,500 crores capex over 4.5 years, so can we assume that we will first see that the consolidation of this additional 1,000 beds happens, and maybe then we will think of having inorganic, because we have brownfield plans as well going ahead. So can we assume that we will expect some kind of consolidation at the existing new facilities? Then we will think of expansion or this inorganic expansion, and whether inorganic expansion will limit to NCR region or periphery of NCR. That is what I just want to understand.
So, at least for the remaining of this financial year, there will be no additional capacity that would be coming to be utilized. We might take a greenfield project upcoming soon, but that will take time for the capacity to come into play. If these hospitals, as we are targeting that, in 15 months, they're getting break even. So, it's not that we have to wait a long to first consolidate and then add capacity. I think we are very well in a position right now also, not this financial year, but in maybe the next financial year, to add more acquisitions, more hospitals in H1 itself, and that's the plan. And second, to your question, as far as the locations and geographies, we believe that the markets where we are present, that is the NCR market, the whole North India market of like big cities in UP, Haryana, Punjab, Rajasthan. I think we want to be in metro cities. We want to be in big cities. It will not be just, peripheral hospitals. All our hospitals so far, if you look at it in the last few quarters, we have added in the hardcore Delhi and Faridabad market, which are big cities. And this is what we also want to continue going forward. Agra is also a big city in UP. So these are the big metro cities where we want to be in the coming years also.
So what is the cutoff ARPOB you have set here?
Sorry, can you repeat that?
What is the cutoff ARPOB you have planned for new acquisitions? I mean, below a certain threshold, you will not want to look at. I mean, location-wise. I mean, is it 35,000?
Yeah, I think upwards of that. I mean, that should be the minimum. That's the criteria.
Okay, thank you.
Thank you. Before we move to the next question, a reminder to the participants, please restrict yourselves to 2 questions only. Should you have a follow-up questions, please rejoin the queue. Next question is from the line of Dhaval Sangoi from Canara HSBC Life Insurance. Please go ahead.
Yeah, hi. Thanks for the opportunity. So Yatharth, just wanted to check your view on this CGHS rate revision that has happened from October. Have we seen any benefit flowing in, and does it any way, impact us positively?
Yeah, the CGHS rate has been implemented recently in the month of October. So we are looking at the upside of the CGHS revenue will be nearly around 1.5% in this FY26, with the benefit of the beta to nearly around 1% in this financial year, which may go up to 2.5% in the next year on the revenue front, and nearly around 1.75% on the beta front.
Okay, so say on a base of 37% of government revenues that you have, we will see an incremental benefit coming in on that.
Yeah, the price benefit, yes, it will be benefit to the company. The rate revision will be adding to the more ARPOB as well, and it will be benefit to the company.
Okay. That's it from me. Thank you.
Thank you. Next question is from the line of Naveen Baid from Nuvama Asset Management. Please proceed.
Thank you for the opportunity and great set of numbers. If I look at your trends for the past 6-7 quarters, your ALOS has been coming down, and your occupancy ratios have also been going up. So in a way, your throughput has been increasing pretty significantly. What explains the drop in ALOS over the last 6 quarters from, say, 4.8, 4.9 to where this quarter we're reporting this at 4.06?
So the introduction of the new sets of technology, like robotics, that's reduced your LOS significantly, right? High-end specialty, state-of-the-art infrastructure. So that's anything which is, earlier, I'll give you example, for any lap surgery where, patient used to stay for 3.5 days or 4 days kind of. Now you can discharge that patient in up to 2 days, right? So adding of the new technology has played a big role in reducing the LOS and, very new sets of, treatment modalities. So this has a role to play.
But if that is the case, then should your ARPOB not have increased by much more than what it has actually, even if I strip off the government segment, which is about, say, 37%, your ARPOB has gone up by just about, say, 5-6% over the last 6 quarters, despite the significant improvement in the case mix. What explains this? Or do you think there's a significant upside in your ARPOB to go up over the next 4-6 quarters?
So you need to see the data of the flagship hospital, particularly the Noida extensions, where we have all those sets of modalities and new technology. So there the ARPOB has significantly increased, right? So it's not like directly you see the 1 rupee increase here and 1 rupee increase there strictly, but I think this is how it should play. So we believe that our more and more the capacity gets ramped up in those super specialty. We believe that I really believe that the ARPOB will also increase.
Also, for last 2-3 years yearly, we have shown 8 to 10% ARPOB growth, and I think for next 3 years also, we do expect 8 to 10% ARPOB growth yearly, and especially now with the Delhi market and the Faridabad bigger hospital having oncology, transplant, increase in international share, that's ARPOB will be a huge lever for us also for going forward. If we continue to be in, as I talked about, big in metro cities, obviously a market like Jhansi Orchha would have been a drag on the ARPOB, but if we are expanding our facilities here in Noida Extension in Delhi, so ARPOB should significantly increase at a faster pace as the capacity happens in these new hospitals.
Sure. Just one more question. So, which is continuing from the previous participant's question, that if your government share of revenue is roughly about, say, 37% odd, if I take the full year impact for next year, wouldn't 2% be too conservative, or this is what you are seeing from your kind of case mix, so that the blended increase is going to be 2%?
So it's, I think, 2.5%.
Yeah, please.
Yeah, please go on.
Sir, also, if you could kind of, split the government revenues into what is derived through CGHS and what is non-CGHS.
Yeah. So, 2.5% is the minimum that, we have said, conservatively. Whatever upside we get from there, we will very well take it. But I think it's realistic to take a 2.5 number because, at a 37% revenue, it's not that 100% of that revenue will fall under the new rate revision scheme. There is part, for example, we do a bit of Ayushman in Jhansi Orchha Hospital, and Ayushman doesn't fall and benefit from this scheme. So overall, I think it's when we have calculated, I think minimum 2.5% gain we should be seeing next year on the overall revenue, not the CGHS revenue. So overall revenues. Yeah, overall revenue upside is 2.5%. So the whole company will be benefiting significantly from this rate revision. 2.5% of the whole revenue, you can imagine, is a big quantum that will be benefiting next year and in the coming years also.
Got it. This is helpful. Thanks a lot.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict yourself to one question only. Next question is from the line of Sumit Gupta from Centrum Broking. Please go ahead.
Hi, thanks for taking my question. So, two questions. First is there any scope of further margin improvement in the mature facilities?
There is, yes, because there is still capacity left to utilize in the mature capacities. When we mature hospitals, when we say they're mature, that doesn't mean that they are saturated in terms of occupancy. For example, both Noida Extension and Greater Noida can reach optimal utilization of 75 of occupancy. So still a 10% room way for occupancy to grow, which will directly flow to the EBITDA. So yes, there is scope for EBITDA expansion in our mature facilities also.
Okay. So because over the last 1.5, 2 years, I think it is at 26 to 27% kind of range. And majority of the drag obviously is coming from the new hospital. So this 27 can reach around 28.5, 29.
It can in the coming years.
So basically, Noida extension would be running at 30 to 33% kind of margin, if I'm sure. If like basically, I just want to ask on Noida extension as well as Greater Noida.
Yeah, I mean, not that high, but, as I said, there are also a lot of recent additions in terms of doctors and star doctors expenditure that we have done in last 1 year. Going forward, a lot of those expenses are being done now that happened over the course of 1 year. But going forward, we will see an upside from those expenses done, which should be able to drive the numbers that you were just mentioning.
Understood. Okay. And the additional 300 to 400 bed M&A that you plan to do over the next 12 to 15 months. So is it already mentioned, like is it additional to the CapEx plan mentioned in the presentation?
So it is inclusive of that 1500 capex.
Okay. Okay. Good. Thank you.
Thank you. Next question is from the line of Gatha Jain from Anantnath Skycon Private Limited. Please go ahead.
Hi, sir. Thank you so much for the opportunity. So I just had two questions. First one is, so what is the cost to set up a bed in a mature or a developing hospital, and how many days does it take for it to break even?
So if you're doing a greenfield today in NCR, it would take you roughly around, 1 crore capex per bed, at least for our brand. That's the threshold, we would be spending. And it takes almost, I would say, 15 to 18 months, which we personally target as a brand to achieve break even after operationalizing of that hospital. If you're doing brownfield, then that capex per bed can be somewhere around 75 lakhs per bed because a lot of medical equipments are already present in one tower. So brownfield expansion is a bit less than the greenfield expansion of 1 crore capex per bed.
And what is the time period for break even for brownfield?
We generally have a EBITDA break even of around 15 months for the new brownfield expansion projects.
All right, got it. And how many total number
Sorry
of
to interrupt, Ms. Jain. May we please request you to return?
Sure.
Thank you.
Thanks so much.
Next question is from the line of Tripti Shukla from Kedia Securities Private Limited. Please go ahead.
Hello, sir. Thanks for the opportunity. My question is related to working capital. Like, your receivable has increased meaningfully this quarter, and cash balance have declined due to capex and working capital needs. So could you elaborate on which specific receivable bucket are stretching the cycle, and by when the debtors day should normalize? Like, also, when do you expect the operating cash flow to EBITDA return to the historical level of 70 to 80%?
So if you see, our debtor days has been reduced. So what we have given the projections earlier also in our earning course. So this time also, we have reduced the debtor days by 8 to 10 days. And we are very much sure we will follow the same trend and we will clock the same 8 to 10 days reduction as on March 2026.
Yes, sir.
Okay. And next
there's one more. Yes, sir.
Sorry?
Yes, sir.
Regarding cash flow?
Yes, sir.
Regarding cash flows, so OCF to EBITDA currently we are at 58%. So we have changed the policy. Earlier we have paid salaries on next immediate day of a month. Now we are matching the salaries payment as per the competition, as per the peers. Okay, now we are making the payment on the same last day of a month. Okay, if we neutralize that effect, so our OCF to EBITDA will be around 78%. It is better than what we reported earlier.
Okay, sir. Okay, so thank you. That's all from my side.
Thank you. Next question is from the line of Vidisha from CRK. Please go ahead.
Hello, sir. I wanted to ask, on the EBITDA margin, you said it will only go upward henceforth. But I want to know, with the new capacities coming in future, how do you see the EBITDA margins improving further? Won't there be any margin dilution?
No, there will be no margin dilution because, as we earlier mentioned, that we still have added 700 beds in just one quarter and still, have this base margin. Going forward, there's no plan to add 700 beds in one quarter, at least for next, 4-5 quarters. There's only an upside of the margin. In fact, if you look at it, we have clearly mentioned that excluding the capacity expansion that we have done, our EBITDA margins would have been close to 26.5%. That is the reason why we feel confident that when these new facilities start ramping up on occupancy, there is a big margin expansion that should happen in the coming years.
All right. And can you give me a
Sorry to
guidance
interrupt,
on
Ms.
the-
Shah. May we please request you to rejoin the queue? Many participants are
Just
waiting
one
for their
second.
turn.
Just my second question.
Ma'am, we restrict to one question only. Please rejoin the queue. Thank you. A reminder to the participants, please restrict your question to one question per participant only. Next question is from the line of Anand B from Kesima Wealth Private Limited. Please go ahead.
Good afternoon, sir. Can you hear me?
Yes, please proceed.
Yeah, I just want to know CapEx, sorry, not CapEx, the census beds of each of the hospitals in this quarter.
So we have a census of around 750 as of date for all the capacity we are in operating.
But can you just break it up from the older and newer capacities as well?
So you need unit-wise breakup?
Yeah. Breakup by hospital to hospital.
In the Greater Noida facility, we have 330 beds, census beds. Noida, one at a time, we have 215 beds. Noida Extension, we have 390 beds. Jhansi Orchha, we have around 250 beds. Greater Faridabad, that is sector 88, we have 150 beds. And the rest of the new facility we just added in this quarter, we just started in the Delhi as well. We have been in ramp-up stage of nearly around 150 each. So that comes to around 1,750.
Okay. Thank you.
Thank you. Next question is from the line of Santosh Singh from Asha Investments Fund. Please go ahead.
Hello, sir. Good afternoon, sir.
Yes, please go ahead. Good afternoon. Please go ahead.
Sir, I have one question. Sir, could you please explain the reason behind the reclassifying loan amounting to 516 crore in this quarter? Additionally, which subsidiary has received this loan? What does the subsidiary do? And what is the intended purpose of the loan, like working capital or the expansion or any specific project?
So basically, it's a subsidiary we have just added. The new hospital which we added in Sector 20 Faridabad is one of the subsidiary for which we have given the capital outlay as per the object clause. We have raised the funds in the QIP. So there is no basically the loan for anything, but it's a kind of object for the deputation and the deployment for the capex as well as the expansion of the hospital.
Okay, sir. Thank you. Got it.
Our current debt levels, are standing at almost zero. So the company is actually debt-free. So there is no current debt that any of the holding company or its subsidiaries have taken as of now.
Thank you. Next question is from the line of Abhay Sahurkar from Convergence Capital. Please go ahead.
Yeah, thank you for the opportunity and congratulations on a good set of numbers. So, I just wanted to know that what are the initiatives taken to improve clinical program depth? Are there any specific specialty lines, for instance, cardiac, neuro, or oncology, or any other, seeing faster ramp up in any of the units?
So we going into the unit wise, we see that what is in the market, and we saw the facility we are lacking the super specialty and quaternary care, right? So year and a half back, we started in flexible hospital node extension with the entire spectrum of cancer treatment and all the transplant programs. Similarly, Greater Noida, we started our kidney and liver transplant program. Delhi definitely going to be a full-fledged quaternary care hospital, including the transplant. Similarly, Faridabad as well. So, what clinical, the treatment modality should be added, that depends on which area we are operating and what are the competitive advantage what we'll have by adding those specialties or results. Similarly, Agra, also we seeing that definitely we'll be having an entire tertiary care of the facilities in that particular, including probably in long-term cancer, right? So this is how we analyze it, which are the gray areas where we need to invest and what would be the ROI, all these things, matrix works.
Perfect. Thank you, sir. And just to follow up on that.
Sorry to interrupt, Mr. Saukar. May we please request you to rejoin the queue for the follow-up question, sir?
Sure, sir. Thank you so much.
Next question is from the line of Prerna Amanna from Equity Research Programs. Please go ahead.
Yeah, all my questions have been answered. Thank you.
Thank you. Next question is from the line of Anand Kulkarni from Front Wave Research. Please proceed.
Hi, thank you for the opportunity. So one question from my end. Can you share the status of the brownfield expansion of Greater Noida and Noida Extension hospitals? Like, when can we expect this to be operational? And post FY28, after we achieve our target of 3,000 beds, how are we looking at our bed expansion strategy? Thank you.
Yes, I think both these two hospitals' capacity should be available for us to be utilized somewhere, 15 months from the day today. So 15 should be Greater Noida and maybe 17, 18 months from today should be the Noida Extension. Because, we will, and the 3,000 bed capacity by 28, I think we should cross it much more even earlier because, there's something planned next year in terms of acquisitions concerned. So that's, in fact, we have revised our bed capacity target rather than now talking about 3,000 beds in 28. The bed capacity would be much more for next 3 years from today. With the Agra addition, we would be around, 2,550 beds. We feel that probably in next 3 to 4 years, there is still scope in the company to even, close to double this capacity in next 3 to 4 years, including all these brownfield expansions that are already in place, the upcoming acquisitions, and one more greenfield that the company is planning very soon within the NCR region. So I think, we are looking at much bigger bed capacity after 4 years from today.
Great. That really answers the questions. Thank you so much and all the very best.
Thank you. Next question is from the line of Abhijit from PI Asset. Please proceed.
Thanks for the opportunity. Just one question. There is a GST rate cut on consumables, reagents and chemicals. So will it be safe to assume that we can retain the benefit?
So there's a change in GST that will definitely help us. So that will lead to around 0.3 to 0.5% of the overall revenue. That will change only 0.2 to 0.5% in EBITDA.
Okay. Thank you.
Thank you.
Thank you. Next question is from the line of Nirali Shah from Ashika Stock Service. Please proceed.
Yeah, I just had a follow-up on the cost of borrowing. So what is the highest cost of borrowing that you can consider acceptable?
As soon as 8% in the future. As on that, we don't have the kind of a debt in the books. However, when we take up the debts, if required be, then generally it comes to around 7.5% to 8% on a rate coupon from the PSU banks.
Okay, and we are guiding 40,000 ARPOBs for FY28. We are consistent on that.
So 10%, 8 to 10%, growth yearly from now. I think we are quite confident of reaching there.
Okay, that's helpful. Thank you.
Thank you. Next follow-up question is from the line of Akshat Mehta from Seven Rivers Holding. Please go ahead.
Hello, sir. Just one bookkeeping question, sir. In this quarter or in this half year, we've seen a slight reduction in our cash flow from operations, sir. There is a bump up in other financial liabilities. You can help us understand what is that?
So basically, as I already mentioned, if there is a change in policy. Company has taken a call to match the salary payment as per the peers. So now we have started making salaries on the last day of a month. That's why there is a change in other financial liability.
Earlier we used to make on the first day of the month.
Yeah.
Okay, sir.
Thank you. Ladies and gentlemen, we will take this as the last question for the day. I would now like to hand the conference over to the management for the closing comments.
Thank you everyone for tuning into the earnings call of Yatharth Hospitals and Trauma Care Service Limited for the Q2 FY 2026. Thank you for your presence.
Thank you, sir. On behalf of Elara Capital, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.